Well, ladies and gentlemen, good morning. Thank you for joining us today. We're very pleased to be with you here today. My name is Fernando Martinez, and I work for the Northwest Mountain Minority Supplier Development Council. In the room here, you've got all of our team members, and they'll introduce themselves in a moment. But I'd like to start off by saying thank you for joining us, and thank you for investing your time in what we're trying to do here. The key focus of today's session really is about helping our minority business enterprises better utilize their financial statements, their finance and accounting statements, so that they can improve and grow their business, right? Develop and grow their business. And a lot of times what our experience tells us that a lot of times that is one of those pieces that is lacking in the toolbox of some of our MBEs, right? In terms of how do we prepare so we can go get more money, more capital? How do we make decisions based on the information that we're seeing in front of us? Are we in a healthy position to where we're growing year over year, or we're growing profitability? You know, that's just one aspect of business health. But really what we're trying to do is we're trying to do this. And we're very, very appreciative of all of you taking time and investing this time, because as MBEs, one of the things that we have to do is we have to invest in ourselves and in building relationships so that we can hit that cross section where we then begin doing business with our corporate members and our public agencies. And, you know, this is funded from our scholarship fund. So every year we raise money, every year we raise funds, and with the intention of really scholarshiping the MBEs across our network to programs such as this. And so we're happy that we have Professor Christina Nichols from the University of Washington. And we're happy that we're partnered with the University of Washington's Foster School of Business. Will Tutall is here, and Gabriela is also, I don't see her on video right now. But we're just happy that you've invested this time in improving your skill sets in terms of growing your business. And so what I like to do is I'd like to just briefly go through an introduction to where everybody introduces you, and I'll just call you based on who I see, and then at the end we'll look at who it is. But just your name, your company, and your company title. No, this is not a sales pitch opportunity. So we're not sales pitching. We're going to get right into the meat and potatoes of today's program, right? So, like I said, my name is Fernando Martinez. I work for the Northwest Mountain Minority Supplier Development Council, and I kind of like I work here. So that's all I'll say. Will.
All right, Will Tutall. I'm the Senior Associate Director for the Consulting Center at the Foster School of Business. Really happy to partner with the council on this.
Hanifa.
Morning, everyone. My name is Hanifa McGovern. I also work with the council, and I am the Manager of Corporate Services, Marketing, and Communications.
Westlake, is that your real name, or is that your?
No, I'm trying to kind of figure out how to change it, but I think I fail on doing that. My name is Carlos Chiquillo. I work with Perk Engineering down in Houston.
Beautiful. Huda.
Good morning, everyone. My name is Huda Musawi, and I handle the certification at the council.
Richard.
Good morning, Richard White. My company is Complement Marine Agency. We write commercial marine insurance, and glad to be here.
Thank you. Sullivan.
Sullivan Kelly, work for Upslope Advisors. We're a consulting firm.
Excellent. Xavier.
Xavier Weeks. I work with the Northwest Mountain Minority Supplier Development Council, and I administer the TAS program.
And TAS is Technical Assistance Services Program. Tom.
Good morning. I'm Tom with the Jamal Technical Services, Construction
Beautiful.
Management.
Excellent. Carla.
Morning. My name is Carla Malakan. I work with the Northwest Mountain MSDC, and I am the Manager of Operations.
Thank you, Carla. Gabriela.
Hello, everyone. I'm Gabriela Michan Rodriguez, and I am with the UDOP Consulting and Business Development Center. I work closely with Will Tutall.
Thank you. Chris.
Is Chris Stanley. I'm with CenterPoint Energy, and I'm in the supplier diversity team as the lead analyst.
Excellent, excellent. Thank you for being here. Validity. How about you guys putting your, how about you guys turning on your cameras so we can see everybody?
Wasn't really realizing this was going to be camera. I'm not sure I'm camera ready. My name is.
That's fine.
I don't know why the camera's not even coming on now. My name is Deanna Lashbrook. I am the accounting manager for Validity LLC.
Excellent, thank you. Dion. You're on mute, Dion. Hey, Dion, can you unmute?
Sorry, I thought I clicked it. Good morning. Our MBE is through Miss Essie's Southern Barbecue, in which I sit as the CEO for that company.
Excellent. Thank you, Dion. Davin.
I'm David Chin. I run a small law firm.
Thank you, Davin. Modu?
Yes, Midu Fakirumi, Cham Food and Beverage owner.
Thank you. L. Frazier. Frazier? How about D. Benny?
Yeah, this is Benny. Hold on. This is Benny. I'm with Propeller Media out of Atlanta. I'm one of the founding partners of the firm. We do digital advertising and we do design work, et cetera, as well. So in the midst of a client situation here, so I am here and I'm multitasking, unfortunately, but we appreciate this opportunity, and I'm tied to the group out of Atlanta, the diversity. I'm trying to think of the organization down here, but anyway, thanks to everybody, and appreciate this opportunity.
Thank you. Sonia.
Hi, I'm Sonia Hobson. My company is Sage Services Group. We're out of the Capital Region, MSDC.
Oh, beautiful.
We're a government contracting firm and specializing in the areas of aerospace systems and program and project management.
Did I miss anyone? Modu?
Yeah, I believe I introduced myself already.
Oh, okay, okay, I'm sorry. So did I miss anyone? Well, ladies and gentlemen, I really would like to take just a second to introduce Professor Christina Nichols. And I'd like to kind of turn it over to her and let her introduce herself and kind of like walk us through. And like I said, you know, please like turn on your cameras, let everybody see who you're at, keep yourselves on mute. And when you speak, don't forget to unmute yourself. So please, hey, Will, any other guidelines, any other rules we need to follow with the Zoom piece?
No, I guess the only other thing is if anybody is experiencing any technical difficulties, Hanifa had sent out earlier yesterday my contact info. So I'll throw it in the chat so everybody has it again. But just let me know and I'll try to help you in behind the scenes to get you back on board.
Excellent, thank you, Will. Professor Nichols, welcome and thank you for being here.
Thanks, Fernando. Thanks, everyone. Good morning, everyone. My name is Christina Nichols, and I'm going to go ahead and start sharing my screen, and I'll give a little bit of background where I come to this from today so that you know kind of some of the examples that I'm bringing in. But I'm very excited to be here. What a more exciting day to be doing accounting on a full day of your Wednesday, middle of the week. I don't know what's better than that, but thank you all for being here. I know you have many things going on as you're running companies and being involved in so many different ways. So first off, thank you so much for being here. All right, hopefully you should see a purple screen here from UW. So today we're looking at financial management workshops. So I'll break it down of what we're covering throughout the different sessions today in the morning and afternoon. Like I said, my name's Christina Nichols. And I'll give a little bit of my background. Feel free to just call me Christina throughout the session today. A little bit about my background. I'm originally from Texas, so I was very excited to see a lot of fellow Texans also on this call today, which is very nice with the ability to be remote, is to reach so many different people and network across the US. So I think that's great. I went to Texas A&M University, and then I worked at PwC as a tax accountant, and then decided to move, once I moved up here, to Holland America Line and worked as a budget analyst and different parts of sales analyst too for them. After working there, I was actually started to teach part-time. So was part-time working and teaching for a couple of quarters at UW, and then decided to move fully into teaching. So as we go through today, I'll pull a lot of experience from prior working, and then also bring in the academic side from teaching at Foster too. So trying to mesh both of those worlds, as I know for today, is mainly to be able to understand our financial management and how do I apply this at the jobs that you're working at. I live here in Seattle. Those are my two cats and my husband. The cats hate taking photos, so as you can tell in this photo. So it's great to be here. A little bit just of my background before we get started today. So thank you everyone else for introducing themselves too. A couple of logistics. I know we already went over this in the beginning, but just things to expect today. 6 hours. Accounting is a lot. We are going to make this as interactive, breakout sessions, polls as we can throughout this morning session and afternoon session. So no, you will not be sitting there listening to me just talk for 3 hours. That would not be fun. So we'll be using polls throughout it. So that'll just come up on your screen with a Zoom poll that will ask your responses. We'll use the chat function too. So periodically I'll ask for just responses from the group, and you're welcome to also respond via chat too. And I'll be monitoring that as we go through. We'll also use breakout rooms. So we'll get into these in probably about 20 or so minutes for our first one. And this will be a chance for you all to talk with people on a smaller scale, meet new people, and talk about some of the concepts and work through some practice problems in those groups too. So when we get to those breakout rooms, there'll be a way, and I'll talk a little bit more about this when we get there, but basically deciding based off your comfort level with accounting when you register, just so that we can get people that are very comfortable in the same group and people that are less comfortable in other groups, so that you can really kind of dive into these topics really deep or kind of higher level too. We'll be in the same groups for the first session, and then we'll switch groups in the second. So it'll give you a chance to network with other people too in both of the sessions. Before breakout rooms, sometimes we'll be working on a practice problem, maybe looking at Starbucks Financial and analyzing them. Often I'll give you a couple minutes on your own just to look at it, take it in before you talk with your groups. And this can be really helpful just to have your first thoughts before you actually start talking in your groups too. And then in your breakout rooms, I'll go into a couple of them just to check in, see how everyone's doing, if you've got any questions. If you have a question for me, there's an ask for help button at the very bottom of when you're in those rooms, and that'll just let me know and I'll come answer any questions that y'all have too. And lastly, there's also a hand raise function on Zoom. I think with this group being around 20 or so that are here, you can also just unmute yourself, ask questions throughout the classes we go through today. Any questions you have, feel free to ask them via the chat, raise your hand, unmute yourself. I want this to be interactive and the ability for you all to get the most out of it. Today, we're going to learn, yes, there'll be things that you learn from me, but there's going to be a lot of things you learn from each other too. And lastly, thanks, Fernanda, for, it's great to have everyone's videos on so we can see, but I also understand if you have low internet connectivity or aren't able to have it on, that's okay. But if you can, it's very helpful to see that there are other people here and get to know each other throughout the session. All right, so a little bit of an overview of also what I'm expecting today is that we'll learn, share, and apply financial management skills. And this is an inclusive environment to share with everyone our thoughts as we go through this and thought process. So share your ideas and thought process in your breakout rooms. You'll learn a lot from the participants in this class. As you notice, we have a lot of different industries, backgrounds that are coming into this class. Yes, you'll learn things from me, but you'll learn a lot from your peers too. And like I mentioned before, questions are always welcome via chat, raise hand, breakout rooms, etc. Please ask any questions that you have throughout it. And then today's layout, from 8 a.m. to 11 a.m., so that's our first session, we'll look at financial accounting. So our goal is to read and interpret some of the financial statements, so primarily our balance sheet and income statement, and then use those statements to assess current and future trends for the company. So we'll be doing some forecasting this morning, and we will take some breaks throughout it. If you need to take breaks during it, feel free. You don't have to let me know or anything, but we will take some prescribed breaks so that you can go get some water, go get some snacks, all of that. So usually around 1 to 2 breaks, try to do those at least after around an hour or so of content. Then we'll have a lunch break in between. I know for some of you in East Coast, this might be a very late lunch break that you're starting now, but a 2-hour break in the middle, and then we'll come back from 1 p.m. to 4 p.m. And that's going to be on managerial accounting. So creating budgets, evaluating variances, and analyzing cost and profit. So again, we'll take a couple of breaks throughout those. All right, so hopefully that gives an overview of kind of what to expect today and the layout. We'll go ahead and jump right in to our first part. So like I was saying, welcome. This first part is looking at financial accounting. So our goals and learning objectives are below. We're going to try to cover, we're covering a lot today. Let me just put it that way. When we think about, all the concepts we're covering, it's quite a lot. So as we go through, take what you can. You've got the slides. I'll be sending out the copy of the annotated slides in an Excel sheet afterwards. But take what you can. I know we're covering a lot of topics, so hopefully some of those stick as we go through. So we'll balance sheet and income statement. We'll look at some ratios to help, trend analysis over the years, start forecasting profits, and then also look at our costs and how to analyze our change in cost and profit. So first off, I know many of you are owners and you probably deal with accounting information a lot, or many of you are working in operations or even on the accounting side. There's so many different things that go into this accounting system. And, essentially I think of it as the kind of center of everything, all the information that's coming in. So 1, we need to be able to track the information coming in, but 2, also be able to analyze and make decisions off the information. So many different groups, whether you're in sales or whether you're in production or whether you're in administration, all of that really comes through the accounting system. And then we can pull reports and information from there. So we're going to first jump into financial statement overview. So as we go through this, there's going to be a lot of different terms. Many of you might be very comfortable with these terms, but some of you might not be as comfortable. So we're going to go through most of these just to give some definitions of understanding. The whole point of knowing what's on their income statement and balance sheet is so that we can also analyze it. So we'll focus more on analyzing it, but we've got to understand kind of the basics first before we move into that. So first off, there's a couple different types of accounting. There's the cash accounting method, which means that our revenue on our income statement is when cash is received. So this only looks at basically cash coming in and cash going out. It's really helpful with cash accounting because you can know your balance at any time for your cash. But downside is that you don't know really your expenses and revenues during a certain period, because you might pay for something 1 month and then actually sell it at a later month. So you don't have the timing that lines up. For many companies that's required, and for public companies it's required to use accrual accounting. So we're going to be focusing quite a bit on the accrual side today, just because when we look at larger companies, like we'll look at Starbucks today, they're using that accrual basis. Just contrasting that with cash, the biggest difference is going to be on our income statement. So that's going to be when revenues are earned, meaning that we've provided the service or delivered the good, and expenses when they happen. And doesn't matter when the cash was paid or not. So less cash visibility with the accrual income statement. So we're going to use our cash flow statement quite a bit when we use the accrual income statement, so we can see kind of both of those at the same time. So before we dive into seeing the different topics within the actual statements, I wanted to give a big overview of the relationship of the financial statements and how do we think about these relating and how do we view these when we're making decisions. So first, kind of think of the balance sheet as a picture. It's a point in time. It shows everything that we have. So our assets, shows all the things that we owe, our liabilities, and then really what's left over as our equity. Now that's just as a snapshot, a point in time. So we want to also know, well, what's funneling into that balance sheet? How do I know if I'm having a profit? How do I know how much cash I have? And that's where we can see from our cash flow statement. So our balance sheet is great to see our financial position today, but it doesn't tell us a lot of information about, well, do I actually have more cash coming in this year or less cash? And that's where our cash flow will talk and tell us about where our cash is coming from and where we're using it, whether that be in operations, investing, or financing. and over that period of time, so we can see kind of over the whole year what's happening. And then on the other side, we also have our income statement. So that also feeds into our balance sheet. And that's going to be saying our revenues minus expenses equals essentially our profit. Just trying to figure out, do I have enough revenues to cover all my costs this period so that I can keep operating in the future too. Again, period of time. So we'll see it over usually a year time period, or sometimes shorter, maybe in months or quarters too. And then how do these relate to one another? So our cash flow statement feeds into the asset side of our balance sheet, with it's saying basically what's on our cash balance in our balance sheet. And then our income statement flows through into our equity side. It'll hit other parts of the balance sheet too, but we'll be able to see really that profit that goes into that balance sheet at the end too. All right, y'all ready to dive in a little bit deeper? So we're going to start with our balance sheet just to have a little bit better understanding of what all the components are in it. So it reports what a business owns and the sources of funding used to acquire those resources, again, at a certain date. So assets, what you own, this could be things, buildings, this is equipment, this is inventory that you have. Liabilities, what you owe. So this could be things like your debt, your potentially, future payments that you have to other people, your accounts payable. And then lastly, your equity, which is essentially what's left over. So if I take my assets minus my liabilities, that essentially is my equity. In terms of, home ownership, you have your house, we subtract the mortgage, and that's essentially like your home equity. Same things goes for companies. Yeah, Dion.
Question in regards to that equity, and I'm sorry because this is so important, some of these sections, so I might have some questions.
No, I'm so glad you asked. Go for it.
Thank you. In regards to the equity, is that something that we can dive down into? Like when they say the owner's equity, what else actually goes into the equity? Because I feel like it's such an ambiguous section in my balance sheet.
Yeah, that's a great question. We will dive a little bit deeper, and it depends on a couple of things of what categories you might see, depending if you're set up as a partnership or if you're set up as a corporation. It might look a little, or as a self-proprietor might look a little bit different, but the same concepts apply. The equity, even if we think about the terms, like the financial accounting board that sets the terms, the definition of equity is actually assets minus liabilities. That is the definition. It's essentially what's left over after you take your assets and you subtract your liabilities. And that's really what your kind of net worth is what's used a lot. But it is broken down into various categories. So the categories being any type of investment that you're getting that's related to investors or yourself putting money into the company. And then also all of your earnings that you've had. So all of your profits get dumped into equity portion too. So you can think of it as basically all the things you've given the company or investors have put money into the company. So that's essentially called your contributed capital. Then your earned capital, the other part of that equity, is everything that you've been doing to run your business. So everything from the income statement gets put in there, and then minus anything you've given back to your investors through dividends or distributions. Hopefully that helps a little bit, but it is definitely a vague category that essentially is the difference between the two. We'll look at Starbucks here just so you can see kind of a little bit more of what's happening on theirs, but those are essentially kind of the two categories to be looking at. And there's a couple of ratios too that we can look at that assesses equity in terms of our leverage and other kind of return on equity too.
I think that's awesome. Thank you so much for that explanation.
Yeah, of course. Thanks for asking the question. I'm so glad. I never know if there'll be questions asked, so keep asking them. It's great to make it really beneficial for y'all too. Always in balance, assets equals liabilities plus equity. As you're looking, it should always 100%. There's no exceptions. It'll always be in balance. So if you think about equity again, you can also rearrange this to say it's your assets minus your liabilities. And it's really what's left over. So we're going to look at Starbucks today. I know this, this is a large multi-billion-dollar company, but is one of the companies as being public that we can actually get the data on. So that's why I brought it in today, and hopefully it's relatable across kind of all industries too, as we think about kind of the industry that they're in, as we think about a retail industry too. So if we look at their balance sheet, they've got both. So those 2 years that we can analyze, our current assets are going to be anything that we are going to use up or convert to cash within 12 months or less. Now, that's important to define our current assets, because we'll use that later as we look at some ratios. Basically, anything that's going to be used up really quickly within 12 months or less. So as we can imagine, we have quite a bit of cash, and quite a bit of cash they actually had at the end of 2020. Could be from probably during 2020, probably taking out a lot of loans potentially to get them through that year. Also have some investments, so that would just be investing in kind of other companies or investing in bonds. Their accounts receivable, that would be anything that they haven't gotten paid yet, but they've done the service for. So for example, if Starbucks sold coffee to UW and UW hasn't paid them yet, well, Starbucks has provided their service. They've delivered the good, they've done their revenue, they can record it on their income statement, but they're waiting on that cash. And so that becomes that accounts receivable. And so waiting on that until that comes in. Then we've got some inventories, which pretty high amount for Starbucks. They have quite a bit of things that might sit for a while on the shelves. That also includes things like coffee beans that they have bought. And then prepaid expenses would be anything that you prepay in advance for that you haven't used yet. Common one would be like insurance, where often you might pay for 6 months of insurance in advance. With the accrual accounting system, you pay for it up front. It hasn't been used yet, so I can't match it with my revenues on my income statement. So I want to make sure that my revenues minus my expenses are just the expenses for that one period or month. So those are our current assets. Then when we get into our long-term assets, which cover things like things that I'm investing in for longer than a year. Biggest one, plant, property, and equipment, which that's going to be all of their, any buildings they own, any type of equipment, all of that. We get into some other areas, long-term assets, goodwill, which is a very unique accounting area when you buy another company. And then they get to basically their total assets at the end. So I'm going to launch our first poll now.
Christina, this is Fernando. Can I, oh, sorry.
No, go for it.
Can you explain a little bit about goodwill so that there's no misinterpretation of goodwill?
Yes, here, let me end the poll first, and then I'll relaunch it so that you don't have that on your screen. But yes, goodwill is a very unique term. When I was first studying accounting, the first thing I thought, and I don't know if anyone else thought this, but I was like, oh, everyone donates to goodwill. Like that is a huge amount that Starbucks is donating to goodwill, or maybe they're donating to other charities. But like the first thing that came to mind was the, Goodwill Industries. It has nothing related. It's the weirdest term. It has nothing related to charitable contributions. It has nothing related to goodwill in terms of the industry, the actual company. What it has is whenever a company buys another company, and they buy that company with more money than the company had as basically on its balance sheet what it had, so assets minus liabilities. If they paid more for it, then this extra amount gets put on the Starbucks balance sheet as goodwill, as this excess value. It's supposed to account for things that are not in the financial statements, things like projected growth. So for example, when a few years ago, Amazon purchased Whole Foods, they purchased it for way more than Whole Foods balance sheet had and their assets and liabilities. And they did that, as they talk about in their financial statements, is, hey, we did that because we saw the potential growth of having a grocery industry and Amazon's network combined, and we see a lot of potential growth in this company. Also, employees are not on the balance sheet anywhere. So also buying, essentially a workforce, a team, entrance into a market, all of that doesn't get put on a financial statement. And so that goodwill piece sometimes captures this extra value that maybe we don't have on our balance sheet already.
So this is Benny. I just have one follow-on question to that. Maybe I'm misunderstanding, but so for example, when Amazon bought Whole Foods was a publicly traded company, right? So in essence, that was money that ended up going to the shareholders, right?
Correct.
So that isn't real money left on their balance sheet, but it is the assumption of growth or something. I just want to make sure, is that real money or is that like not real money? I don't know how to say it, right?
No, that's a good way to put it. It's not real money. It's yeah, it's just the potential of growth. They spent the money actually that through, you know, let's say for Starbucks, if this was, you know, Amazon instead, that was money that they spent. They just, when they acquired Whole Foods, they acquired it for less money. And they said, but why would it, the thought in economics is why would anyone ever overpay? They're paying for something. We just haven't identified what they're paying for. So they must be paying for something. They're paying for all these future benefits, but it's not cash. It's not anything that they could even use later on.
Yeah, that's what I thought. I just want to make sure I wasn't missing something. Okay, thank you.
Nope, you got it. Thanks, Benny.
All right.
Hi, Christina. I have a follow-up question.
Yeah.
So if a company, if a company buys a company, that makes sense for goodwill, but if a company hasn't gone through that process, but has, I don't know, let's say Coca-Cola at the beginning, Coca-Cola had the brand name and that's the goodwill for the company as well. And they, you know, how do you monetize that? How you put a value into that? Or does it have to be something, does it have to be like a purchase of a company that the equity goes into goodwill?
That's a great question, Carlos. So the only time goodwill can come up is if you purchase another company. So if things are internally generated, like brand name or your sometimes your customers, like all of these value that you have that you might not put on your balance sheet, none of that, or research and development, all of that mainly gets expensed in the period because you don't have a transaction to really know the true price of it. And so the reason why goodwill gets added when you buy another company is that, hey, now we have a price. We're putting a value on this extra amount. You know, it can be for many unidentified intangible items. Now, the idea of internally generated, a lot of teams like, so for research and development, that all gets expensed in the current period. So if we think about Pfizer, for example, all the research and development to get the vaccine ready to be sold, or just actually approved by the FDA, all of that gets expensed because there's no way to know whether it has a future benefit or not. And so most of those, you know, even sometimes brand names can be looked at as intangible. So in this category here, sometimes you can, if you can get a value for it, but I think Coca-Cola's brand name is very small comparative. Like the value on its balance sheet is so small compared to what we actually think the brand name is probably worth.
How do you put a value into a brand name? I mean, how do you value intangible assets?
So yeah, that's a great question. A lot of times we can't value many of them. So a patent, for example, if we are internally, you know, doing research and develop this patent, again, I'll use the vaccines as an example, none of that can be actually put on as an asset, as an intangible. The only time we can really put intangibles on is if we've actually paid basically an external party for it. So if we bought a patent from another company, yeah, the accounting rules say, hey, you've got a price, there's an external value for it, yeah, we can put it on. And the reason why there's so much around like, how do I, you know, I have all these valuable items, but I can't put them on my balance sheet is because there can be room for overstatement of those assets. I could say, yeah, I think my brand name's worth $5 billion. Well, if we don't have an external price, it's really hard to validate what that would be. Great questions, everyone. Any other ones as we look at assets here?
Christina, this is Fernando again.
Yeah.
As you look at those intangible assets and you try to evaluate it, is it kind of like, do you do like a market study, like companies, you know, similar industry, same size? Is that what you would look at, and what they're how they're evaluating things?
So whenever, probably the biggest time this happens is actually when you purchase another company. So I'll use another example of when Alaska Air purchased Virgin America. They use third-party valuation experts, and that's similar. They would go and say, if we were, there's a couple of different ways you can go about valuing that. There's essentially a market price, and internally, kind of present value, a future cash flows price, fair value, all these things that can be used different ways to approach how to value those. It often happens when you buy another company because you're hiring this external party to go and value it. For example, I'll use back to the Alaska Air. They had, when they bought Virgin America, Virgin America had tons of customers that were not part of the basically Alaska group at all. They were done, as their frequent flyer members. And so they were able to assess like how much those people were spending, assess their value, and assess it over, over a couple of years, how much they think they would then get revenue generated from those new customers. Now, that's sometimes not always can be put on the balance sheet, but when you purchase another company, there's a lot of times you can put new assets on, and that's because you have this purchase price that you can allocate to these intangibles, essentially.
Mm-hmm. Thank you.
Yeah. All right, I'll relaunch that the poll now that hopefully you can see, just to get a grasp, make sure we've got a good understanding of what components go on the asset side. I should preface that you own a pet store in this problem. All right, awesome. I think we've got most of them answered so far. Great. Okay. We came out at 67% is equipment or other long-term assets. That would be correct. So these tables, the difference between inventory and expense, I see those are the other ones that were picked, is that equipment, anything that's going to last longer than a year and that's going to be used to generate revenues would go on as a long-term asset. So that's a reason why we wouldn't expense it immediately. Again, following kind of the accrual accounting, we're going to actually put it as an asset, and then over time we'll depreciate those tables and be able to match that expense of using that table to help generate revenue. Now, for a pet store, they're not planning to sell the tables, which is why it wouldn't be inventory. Now, something like pet food would totally be inventory. They'd buy it and then they'd sell it later, and that would classify as that inventory. All right, awesome, nice job. So we're going to move over to liabilities and equity. So our other side, the flip side of an accounts receivable is an accounts payable. So this is just from the other perspective that we see the accounts payable side. Yeah, Dion, did you have a question?
Yes, sorry. Just before we move to the other side, can you go back to the, yes. I just wanted to make sure, do you mind just running through real quick, like just maybe even a word response like what you just did? So like inventory are assets that you sell versus assets that you use in your space. Prepaid expenses, and what, do you mind doing that really quick just before we go to the next?
Sure, yeah, so you've got great definition I already gave of inventory, something that you plan to sell later. Your prepaid expenses is something you've paid in advance for that you'll use later. And best example would be your prepaid insurance. So you might pay for insurance to be used over 6 months. Today it's a prepaid, but eventually it'll move into an expense on your income statement once you've actually used, had the insurance for that period. Not even that you got anything with the insurance, just that you had that protection that period. Let's see, what are the other ones? Accounts receivable, essentially that you're going to sell something, get paid later. So it's an IOU from your customers. And probably the biggest, there's a bunch of other ones that might not apply for all of these, but plant, property, and equipment would be something that you're planning to use in your business, but for longer than a year. You're not planning to sell it. It's just things that you're purchasing, like computers, desks, tables, all of that that you use in your business. And I think that's probably most of them. There's any other ones, Dion, that you wanted a definition of?
So deferred income, and I know you were talking about the goodwill, but yeah, like deferred.
Yeah, our deferred income taxes, this happens because there's a timing difference between what you pay for taxes. So there's different tax rules than financial accounting rules. The biggest one might be that as depreciation. So depreciation for tax rules, sometimes you can take all of your depreciation in 1 year and take it as a deduction. For financial accounting purposes, you can't do that. You have to do it usually straight line over a couple of years. So these differences come through deferred income taxes. It's, I would say, very important from maybe tax perspective, but less mainly just calculating the difference between a tax perspective and financial perspective.
Okay, and I appreciate that, because at the end of the day, I don't know how many other people in this group, but a lot of people, we own successful businesses. We've done a lot of businesses and can't properly read a balance sheet to the degree that maybe we rely on our CPA to do it, right? But we should as owners.
Yeah, no, that's great questions. Please stop me anytime, because you're right. I mean, the more also that you can ask, questions, if you have hired a CPA, like better questions you can ask, or just understanding yourself can be very beneficial.
Thank you.
Yeah.
Christina, I wanted to ask, where do you draw the line on what you choose to expense and what you choose to put in plant and equipment type thing? Like if I buy a desk for $200, typically I just expense it.
Yeah, no, it's a great question. So this comes into like the term is, a lot of times we would say capitalize versus expense, or put as an asset versus expense immediately. It's so much into judgment. I would say that a lot of times it can be just helpful to have a threshold. So everything from thinking of talking to other companies, it's like, depending on the size of your company, but maybe everything under $2,000 or $3,000, I just expense. If I'm a pretty large company, I don't even want to think about capitalizing something that's $2,000. If I'm a $5 billion company, I'll just expense those immediately. Now, anything that's more than that, then I have to decide, is this something that's going to benefit me longer than a period? Then, honestly, you could capitalize a desk for $200, but the process of capitalizing and then tracking it, it's probably not worth, kind of that time as far as that threshold goes. Probably the biggest thing is there's a couple of things that should always be expensed, repairs and maintenance, anything that's kind of a common thing that you're doing. I think for like a car, if you're doing oil changes, like that's just should be expensed immediately. Things that are benefiting you for a longer period. So if you're doing a big renovation, getting new systems in, then those can be capitalized and then depreciated over the life. So the classic accounting, it depends, but it's gonna be helpful to have a threshold.
Thank you very much.
Yeah.
Christine, could I ask you a question, please?
Sure, Sullivan, go for it.
In talking about capitalizing items and whatnot, and should you expense or say depreciate? Should you depreciate it in a one-time shot or lay it out over several years? What's the best way so it reflects on your balance, on your income statement?
Yeah, that's it. So if let's say you capitalize, let's go with, a bunch of tables, and you're planning to use those tables at the pet store for, the first step would be to figure out how long do I plan to use those tables, not how long the tables might last for, just how long am I using those tables to generate revenue off of. So the best would be to assess that useful life. And usually there's kind of standards, they might be similar even to your tax ones that you have, but for equipment, usually sometimes might be furniture, 7 years maybe, and then depreciating that over the life of those 7 years. So first thing would be to, try to figure out the useful life of that and then depreciate it. But it's much better to depreciate over that life than depreciate all in 1 year for financial accounting purposes, because you want to make sure to match that expense. So a portion of that table you're using every year for 7 years to run your business. So we want to make sure that a portion of that gets put on our income statement so we can match what I'm selling. Hey, all the costs to generate those sales equals my income profit for that period. if I expensed it all in the first period or all the first year for financial accounting purposes, you're going to have like, you know, maybe a loss, and there's no need to have that loss because you're using that over, say, 7 years.
Thank you very much.
Yeah, tax purposes, different story. You want to try to use, you know, probably get your cash earlier. So for tax purposes, if you can use bonus depreciation and get that deduction earlier, that's just cash in your pocket earlier. So that's a little bit different perspectives, tax versus financial accounting.
Thank you.
Yeah.
Christina, this is Fernando again.
Yeah.
When you decide to depreciate, do you depreciate over what you're, like say, for example, these tables, 7 years, do you depreciate over 7 years, or is there a value in knowing that you're going to use them for 7 years, but you're going to depreciate them over 5, or is it just to make sure that you're benefiting from a tax perspective?
Well, you can use either, they're different methods. So whatever you choose for financial accounting, you can do something completely different for depreciation for tax purposes. That's where that actually, where Dion brought up that deferred tax asset is the difference between those two, basically rule set. Yeah, so it doesn't matter. In that case, some other cases, you have to do the same things for tax and financial, but depreciation is pretty much always going to be different between the two.
Okay.
Oh, Davin, the same, can you explain, I probably missed that in the chat, the same for cash accounting, what that question was for?
That was back to when we were talking about the table example, and that being a long-term equipment type thing for an accrual accounting. And I was just wondering if there's any distinction if you're doing cash accounting.
Oh, good point. Okay, yes. So that's a great point. If you're doing cash accounting, a lot of those purchases, things that are used for operations, those, I'm going to be honest, I'm not as familiar with cash accounting. So if anyone's an expert on cash accounting, what you would do for tables, please let me know. I definitely feel much more comfortable with the accrual basis, but a lot of times for cash, it's anything you're spending on, but I imagine it'd be anything you're spending for operations. I'm not sure if tables would still probably go as a long-term asset, but I'm not actually 100% sure. I don't know if anyone else is on the cash accounting side.
Okay.
Yeah, sorry, I wish I had a better answer. I know for revenue purposes, it's anytime cash comes in and like inventory, you would do that as an expense immediately. And maybe also for long-term assets. I'll follow back. I can follow back up after the break today. Sorry about that.
Thank you.
Yeah. All right, great questions, everyone. We're gonna move to the other side. So our liabilities and equity. I'll go through the ones that I think are most common on financial statements and kind of go through them a little bit slower as we go through to get the definitions too. First one, accounts payable. So this would be the opposite side of the receivable. So this is things that you owe money to as the company. Short-term amounts. So this would be an invoice that if you've got an invoice and you have to pay that invoice in 6 weeks from now, well, that would be an accounts payable until you actually pay it. From the example of Starbucks selling to UW and UW not paying them back yet, well, for UW, they would record, I got the inventory, the coffee, or if they're not selling it, I got, an item. And then I have this payable that I'll have. So it's something that you owe short-term periods, usually less than kind of, over a couple of months. Accrued liabilities, those are, again, similar to accounts payable, but anything that you might not have gotten a bill yet, but you know that the amount's coming in, we go ahead and record it as an expense, and then you show that you have this payable. So again, amounts that you owe to someone for something that has happened so far. And then along that, probably the most common one are accrued payroll and benefits that can also be lumped with accrued liabilities. So all of your, for example, employees, if you're not paying them, every single day, if you're paying them, a couple of weeks after they've worked. Well, for my financial period of, say, the month of January, anyone that's worked in January, that's an expense in January for accrual purposes. Even if I haven't paid them yet, it still reflects costs that I had to generate the revenue in January. Now, that payable amount, the amount that you owe the employees for amounts you haven't paid yet, same with actually vacation that's owed or other benefits, That comes through as this accrued payroll benefits or liabilities. Income taxes payable, that'll be anything that you owe for taxes. So anything that you haven't paid yet that you owe, that you basically have happened at this point in time, but haven't paid yet. Let's see what, oh, my favorite, store value cards. So this is a different under accrual versus cash for how gift cards are treated. But for the accrual accounting, gift cards are actually treated as a liability. So the moment Starbucks sells a gift card, they got cash from you, but they actually, what they've given you as an IOU, they owe you, you know, a coffee, food, service, something later on. So under accrual accounting, it actually gets put that gift card as a service that's owed to someone else. Cash accounting, that would be different. It would just be revenue under the cash accounting model, but under the accrual model, it's actually a liability. So this can be a good place to look at your, you know, balance sheet, income statement, and cash flow statement, because it's great to get the cash in from gift cards, but knowing you're going to have, you know, inventory outflow or service outflow at a later date is important to track kind of that timing difference too. And then the next couple ones, probably the most common one is our debt, which we can, you know, see a big increase in 2020 for their long-term debt, which caused that big increase in their cash balance. And so that long-term debt, anything like, you know, note payables, bonds, anything that they owe to banks or institutions. I think that covers most of the big ones for our liabilities. Again, we have our breakdown between current and then our long-term ones, just again to show things that are due within 12 months or less and things that are going to be due, you know, anywhere past 12 months. So it can be 30, 40 years. Those would all go in the long term. And then back to the equity section, like I said, there's not, you know, there's not a whole lot as far as what's left over, how it's broken out. There's not as many categories, but they're pretty important categories that come down. For Starbucks, their common stock and additional paid-in capital, those are all contributed capital. So that was that I was referring to earlier. All the money that's been received from investors. So that could be from, you know, other investors putting money in, from if you're an owner of a company, this would be your owner's equity as far as putting money into the company. These things are, you know, kind of odd things that happen. I wouldn't, you know, out of scope for our class today. So the other piece of this is then our retained earnings. This is our earned capital. So what happens, I know they're in a negative position due to they actually reissued a lot of, bought back a lot of stock, which affected that number. But generally what goes into this most typically is all of the earnings. So your income statement actually goes into retained earnings. And then that number rolls forward every single year. So that number is the combination of basically all earnings over since the company essentially started. Now, Starbucks has a negative number here. That's primarily related to some other accounting items that affected them with some stock buybacks. But you know, they have been having income over the past many years. So that if we broke that down further, we would see the income that gets dropped in there.
Christina?
Yeah.
Can your organization own in total or in part a company that provides dividends? And where would that go on your balance sheet?
Great question. That actually goes in this this retained earnings or earned capital. So the most typical things that affect retained earnings are going to be your net income. So that's your profit from your income statement, and then any distributions. So your dividends come directly out of that retained earnings number. So it would come directly out of that equity portion. For for owners, a lot of times that aren't, you know, for this company, it's a publicly traded company and it's set up as a corporation, but sometimes you might just see like an owner's account where you have investments in, investments out, or money in, money out, and then that income that's dropped in the year. So sometimes you can see this all in one account, but it'll generally come in through something called retained earnings.
Thank you.
Yeah. All right, great questions, everyone. We are We've got a couple more areas to go through, and then we will go into our first breakout room. I think I have us here. Yeah, we'll do our first breakout room, and then we'll take a break after we do our first breakout room. So now using, are there any questions though on liabilities and equity before we move into ratios and analyzing this data? Okay, sounds good.
I had a quick
Oh, yeah.
question, just
Yeah.
out of curiosity, and
Sure.
nothing that is gonna affect me anytime soon. But for the store cards, I mean, I know a good percentage of those, they're never claimed. How do you balance that in your balance sheet?
That's a great question. And that's actually changed a couple of years ago. So it will, if the way it works now is there's something called breakage. So you actually estimate it up front, and you basically get a convert. So let's say, we think based off historicals, we know that 5% of all our gift cards never get redeemed. Well, that 5% shouldn't sit on our liabilities forever because they're never going to redeem them. So it's kind of just like free cash and free revenue for me if I'm not having to ever, give them an inventory item. So what happens is that some states have different rules. So it can be honestly depend on the laws in the states. But for most states, what happens is they can estimate that 5% and actually move it into revenue periodically based off of basically a schedule they can use. So a lot of times that's over, a couple of years, they actually will move it even if it hasn't been redeemed yet.
Got it, thanks.
Yeah. All right, so we're going to move now using that base. We're now going to move into now analyzing it for ratios. So how do I look at this data? How do I make some interpretations of it, show trends over years, and compare from last year to this year? So what we've done kind of so far is we've looked at, okay, we've got to collect all this information in the accounting system, understand the business, understand everything that's on the balance sheet. And then what we're going to focus on now is the ratio analysis. Later on, we'll then use past data to forecast the future. So that will be later on. But right now we're going to look in the past and look at some of those ratios to help us interpret how things are looking on our financial statements. So the first one we're going to do, and then we're going to get in breakout rooms and actually discuss this one to see kind of our different insights. So solvency ratio is basically the ability to pay debts when they come due. Now it depends on both liquidity, so how much cash do I have or how much can items turn into cash, and then heaviness of your debt load. So how much of my assets are funded with debt versus how much are funded with equity. So there's quite a few different ratios, but I think these ones are going to be really important to look at in conjunction with each other too. So liquidity, the current ratio takes our current assets. So remember, that's anything that is cash or going to be used up or converted to cash 12 months or less. The list on Starbucks balance sheet is a great list. That's pretty typical for most companies to have those same amount of items in their current assets. And then current liabilities are anything that I have to pay within 12 months or less. Again, Starbucks has a great list of theirs is pretty typical for any company too for current liabilities. And then our leverage would be our debt to assets, which would be our total liabilities over total assets. The way you can think about for our leverage, for example, is let's imagine my leverage was 0.7. So sometimes I like to interpret this as 0.7 over 1 to think for every dollar of asset I have, that's funded basically 70 cents of that dollar is funded through debt. There's only two options for ways to get funded for our assets. It's either through debt or it's through equity. So if we take our total liabilities over total assets, the smaller the number for our debt to assets, the less leveraged you are. The higher the number, the more leveraged you are. Now, we'll talk in our groups, is too much leverage a bad thing or a good thing, or where's the mark? I'll let y'all discuss that in your groups and we'll come back here in a little bit and hear from everyone. The current ratio, just to be thinking about that one, you can also put this over 1. So let's say we had a current ratio of 2. That just means for every $1 of current liabilities, I have $2 of current assets to cover it. So I'm at a very healthy spot there, right? If I have more assets than liabilities, that means everything that's coming due, hey, I can pay that off. Anything that's less than 1, well, we just have to know that, hey, we have to have some more cash then, or else we won't be able to pay our employees or our accounts payable, things that are coming due really soon. So what we're going to do next is we're going to discuss a couple of these questions. So we're going to go into our breakout rooms here for our first one. So I'm very excited. You'll get a chance to meet other people. How we're going to do the breakout rooms is you'll actually be able to click, it'll ask which room you want to join, and you can join a room. You'll stay in those same rooms throughout the rest of the session this morning. We're trying to do a max group of 4 per room. So choose it based off of also your comfort level, with 3 being the, yeah, thanks, Will. Awesome. 3 being the comfortable, or 1 not as comfortable in those rooms. When you get into your rooms, if you can, again, say your name, your pronouns, the company you work at, or industry, and your role, just as a refresher for your group. And then, you know, something you're looking forward to in the next week. That can be anything from reading a book to seeing friends or family. And then as a group, so after everyone's introduced themselves, as a group, I'd like you to look at the next slide here. And this will go away in your breakout room. So if you don't have a copy of the slides, take a picture of this, screenshot it, because you'll want this in your breakout room. The questions I want you to answer are, between Starbucks and McDonald's, which one is more leveraged, and which company is more liquid? And then after that, you can decide, is there a benchmark? Like, can you ever be too liquid, or can you ever be too leveraged? And is that a good or bad thing? So I'll give you quite a bit of time in this breakout room for introductions and to talk about this kind of mini case here. So we'll probably spend about 8 or so minutes in these rooms. If you have any questions, you can always come back to the main room and come back to the breakout session, or click the little ask for help button at the bottom in your rooms too. All right, any questions before we try out our first one? Okay. All right, hopefully you're able to choose. If you look at the chat, Will's put in which groups to go in. Level 3, you can choose any of the level 3 ones, or level 2 or level 1. We're trying to get no more than 4 people though in each group. All right, everyone, welcome back. We will discuss and kind of as a group regroup about what y'all discussed in your breakout rooms. And then we will take a break. I promise you. I know we're already at 9:20, it goes by fast, but also definitely need a break here for everyone to take get some water and stuff. So let's go ahead though and first discuss this. I'll just ask for volunteers maybe from the different groups. First off, actually, I have a poll. That'll be much more efficient. Let's see. All right, in your groups, let me know which group what did you decide? Which company is more liquid, Starbucks or McDonald's?
For what year?
Oh, good question. 2020 for both of these.
Right.
All right. Wow. I just have to show this. Nice job, everyone. Yes, we have Starbucks as more liquid. We've got the higher current ratio. And let's do one more, and then we'll discuss other items that y'all brought up in the group. So let me get the next one. Okay, what about which company is more leverage? Again, let's do for 2020. All right, awesome. Thanks, everyone. Yes, majority have said Starbucks. That is correct. They are more leveraged. Actually, have more debt than assets in this situation. That was because they had that negative equity in the past in 2020 and 2019. All right, so now I want to open it up. Now that we've got leverage and liquidity, is there ever a point? What did you in your teams discuss? Is there ever a point where you can be too liquid, or that number be too high for the current ratio?
I'm not sure we discussed that in detail. Just sort of, walking around since in terms of what we hear. We hear often that particularly some of the technology companies have a lot of cash on the balance sheet. And, so the market or the investors kind of rattle the cage like you need to be doing something or you need to be giving us money back, right? So that would be the only thing I have to say about these large companies. I mean, for us, we try to keep as much cash on hand as possible, just in terms of covering expenses. That helped us, get through 2020 with the pandemic and everything like that, right? To have money on hand. So we were fortunate in that regard, but I don't have anything else to add there.
Yeah, thanks for sharing some reasons why we might want to have that current ratio higher and just have that higher liquidity in some situations.
So yeah, to kind of add a little bit to that, for smaller companies, it's key to have liquidity and not a high debt ratio. Larger companies like Starbucks and McDonald's, they have easy access to cash from banks or from selling assets, which is easier for them. For smaller companies, it's always more recommended to kind of have liquidity and not that big much of leverage.
Yeah, Carlos, that's a great point. Just the access, the ability, and how quick can you access it? Do you have a line of credit, or like what other options do you have that can totally determine where your current ratio, whether it's too high or low, dependent on the size and your ability to access cash quickly.
Part of our discussion also, Christina, was understanding, how much money you need in order to stay in operation, right? And understanding what your liabilities are. And so, and it was all around the business that Carlos just described. How much do we need to pay? What are our liabilities? How much cash do we have? And how do we project what our position is going to be, right? So I think that's, for as I'm thinking about our MBEs, I'm thinking like, being liquid is better than not being liquid, right? So because we don't want to run out of money, because then that leads to many other things. So that was kind of more of our discussion.
Yeah,
we didn't come up with a, is there a number where it says we're too liquid? But for a 501c3, for example, our focus is having 12 months in reserve. But benchmark is 6 months, but our focus is 12 months, right? So for nonprofits, 6 months is benchmark. So that's kind of a number that we operate under.
Yeah, that's a great point with benchmarks too, and it can depend based off different industries that you're in, based off how you're structured as a 501c3 versus other companies. So I think that's just a really important takeaway, I think, from everything that y'all discussed about, wanting that, measuring out your future cash flows, which we'll talk about here in the second half too, a little bit more on cash flow later this afternoon, and having that liquidity and knowing those interest payments that are coming up if you are highly leveraged. So it can be really important. Great, thanks everyone for sharing. I really appreciate it. Thanks for also, I know, a little hiccup with the breakout rooms, but thanks for being flexible as you're in there, and hopefully had some good discussions. We're going to go ahead and take a 10-minute break now, just to give you some chance to not look at a screen, if you've got to answer calls, all of that during this break. So that brings us back. Let's come back actually. Sorry, I'm going to do 9 minutes just so that it's an even 9:35. So let's come back at 9:35 and then we'll jump back in where we left off with some more ratios.
All right, 12:35.
Oh, thank you. Yeah, sorry. 9:35 in Seattle, but you're right. 12:35 or 11:35 in other places, or 10:35. So.
Christina, are you leaving?
What'd you say?
Are you going on break?
I was gonna go for a couple minutes, but I can answer questions before that.
No, that's fine. I'll wait till later. I'll wait to ask it later.
No, what do you have? I want to get it. Let's do it now.
I didn't understand how we were able to do the math on the finding the answer to that. So on that chart, we had 106 and 0.92. How did we derive to that answer without having McDonald's, the balance sheet for McDonald's?
You're right. We couldn't have done it with getting McDonald's because unless we wanted to go find their information online. You're right. I didn't send it to you, but we were you able to see Starbucks, what goes into it? Do you want me to show you that?
Yeah,
here?
so I saw Starbucks, like their total assets was 29,374, and then their liabilities were 7,346, right? 0.8.
Yeah, so it'll for the leverage one, yep, it'll take this total liabilities of 37,174. So the total, the one on D39, and then the assets would be that 29,375. So if we take 37 divided by 29, we should get, that's for 2020, that leverage ratio.
Is this the Excel sheet that you added, that you gave us?
Yeah, you didn't have to find it for this one, but you can now. Now it's a good way to like solve for it with the, yeah, I kind of have them listed out here if you want to solve for any of them too. We'll practice it later too if you want, but that at least gives you the supporting documents to find it too.
Okay. That's where you were drawing the numbers. Okay, I couldn't do the math because I was trying to figure out where you were pulling the numbers to make that chart.
Got it. Yes, they're pulled from their financial statements. And you're right, McDonald's, I didn't give those to you, but you can do Starbucks if you want to check and see, okay, well, let me see what really were their liabilities, how much higher than the assets were they?
And how did we come to the understanding of which one was higher than the other one without doing the math?
Got it. Okay. So if we we can actually just look at these and not have the support for it. And we could say that for our current ratio, it's current assets over current liabilities. And so it'll be basically if we put anything over 1, because that'll be like 1.06 over 1 would be the essentially same thing as 1.06. So I can say, basically I have $1.06 of current assets for every $1 of current liabilities. So I have more assets than I have liabilities versus McDonald's. I only have $1.01 of assets for every $1 of liabilities. So less assets to cover my liabilities.
Okay.
And it's not looking, the ratio looks at, this is what's nice about the ratio, you can compare, even if you have, even if your cash balance is lower than last year, you still want it just in comparative. So it's not in, total dollars difference, but it's looking at the comparison between the two.
Okay. Thank you.
Yeah, no problem.
Christina?
Yeah, what's up?
A quick question. Why large companies like Starbucks or McDonald's tend to have a higher debt to asset ratio, like over 1? Is that, what is the reasoning behind that? Wouldn't that be counter-effective for them?
Yeah, it looks, what happened though for both of these companies is not necessarily, they had negative partially in 2019, 2020, there was new things added in for lease liabilities, a new way of accounting for them. So that's part of the change, is that these leases for Starbucks caused quite a bit of increase, even though it was no difference on their cash flow. It's just the way that it was reported for accounting purposes changed. So that caused some differences on both the asset and liability side. And then also they had some stock buybacks, which caused a negative equity and loss of cash. But so in that aspect, that's why they have that negative equity amount. But the debt to assets, you're right. It looks pretty off, right? You're like, how do I have more debt outstanding than I have in assets? And it's less worrisome for based off looking at some of what's in their financial statements, but still something to be aware of. Retail companies in general have pretty high debt to assets, like Nordstrom's and Macy's have close to 1 liabilities to assets, a lot of times because of all of the locations that they have and buildings and leases that they have outstanding, cause some of this to be a little bit higher.
Gotcha. Hey, one other question now that I have you.
Yeah.
So I used to own a company and it was an LLC. So whenever we did the taxes, we started doing an accrual method from the beginning. and it's hard to kind of change after you start doing it one
Yeah,
way.
totally. Yeah.
Well,
It's a good method though, in case you ever sold it. Sometimes you have to switch to
yeah, it helped when we sold it, but at the end of the year, when you get your K1 on accrual method, it sucked because you're basically paying for stuff that was coming on later. So you can do what is better for a smaller company to kind of, because on cash method you are paying for what you have. So sometimes, you know, I used to do international work and I used to get paid 120 net 160. So I was basically paying on December what I needed to be paying, the money I was going to receive on May or something like that. But what is better from your experience? Or is it better to kind of have a limit, like not an LLC, but a corporation where you don't have to kind of get into your personal taxes? I don't know.
Yeah. Oh gosh, Carlos, there's a lot to that question, but I don't know I'll be able to really assess all of it. It's a good question, I think, in terms of, because you have to look at, I think it's more of almost a tax question than a financial accounting perspective question, in terms of, you know, there's definitely pros and cons of different ways you structure for tax purposes, also liability purposes too, right? For the LLC instead of just a regular, you know, how it's structured with the K1s and S Corps and going through. It depends on also like comparing that to the corporate tax rate, especially if that it has changed and, you know, probably will change again in the future too, of just assessing those rates. That can be some of the biggest things. As far as there, you know, the things that I would remember is for accrual, I think personally, I think accrual for financial purposes is so helpful in determining how much like really gross profit and kind of profit I'm having that period, because it just matches expenses with revenue. I'm also probably biased because it's, you know, the preferred method for the FASB puts out too, and for a lot of reasons why. But you know, with that, then you also have to track your cash flows really well too. Now, for tax purposes, the one thing I would note is there's a lot of differences with tax and financial accounting that you can adjust for. Even if you're using the accrual basis, whenever you go to do your tax return, there's some different, you know, methods you can essentially use, like I think the bonus depreciation one and stuff. So just utilizing those different tax incentives too that are out there.
Gotcha.
But yeah, sorry, I'm not going to be a tax expert anymore either. I will mention that it's quite a few years ago now that I've delved too much in the tax area, but knowing that there are some differences between.
No, I understand. It's a loaded question.
It is a loaded question, but a good question to ask, like, you know, as you think about the next company that you have, or like, you know, talking with your accounting team or CPA, you know, about what are the pros and cons for structuring it and a tax impact of that.
No, and that was it. When we sold the company, it was good that we did an accrual because it was easier for the company that bought us to kind of understand what we're doing. But at the beginning, it was painful because we're paying pretty much upfront at the end of the year. But I'm thinking of doing something else. So I was kind of thinking, well, what route should I go? So that's the question. But thanks.
Yeah, I would say, yeah, accrual. It's just helpful, like you said, that I think as I know everyone's coming back now, just benefits of cash versus accrual method. If you're selling, Carlos had mentioned, if you're, you know, selling your company to someone else. Also, if you ever decide to go public at one point, it's a huge hassle to convert from the cash to accrual basis. We had to do that for a company when I was at PwC, and it was just a lot of time and money, honestly, of converting all of those past financial statements over the years. So, you know, as you start growing, especially in your business, it can be helpful to switch to the accrual just so that you are ready in case you wanted to ever sell it or go public at some point too.
Gotcha. Thank you.
Yeah. All right, everyone, welcome back. We've got a couple more ratios to look at, and then we will look at some forecasting and get to that Excel document here a little bit later too in this first session. So I think everything's back up. Okay, great. So where we left off was liquidity and leverage, and I think there's some really good points made in far of, you know, definitely having a lot of that ability to pay off those debts coming due, having enough cash or liquid items to kind of last us through, especially if we have hiccups that happen or things that are unanticipated too. So we're going to look at our next financial statement, which is our income statement. And again, I'm going to go off of the accrual method here. So some of the definitions for what goes into revenue and expenses, this is where you'll find the biggest difference between cash versus accrual. And a good reason, I'll kind of say why there's some benefits with using the accrual with the income statement, just matching everything in the same period. So we're reporting revenues and expenses over a period of time. So generally this might be, you might do them monthly, but definitely probably every year. Revenues are inflows from day-to-day activities. So this is referring to whatever I've provided a service or delivered a good under the accrual method, I can put it as revenue. Even if I haven't gotten paid for it, and say I have an accounts receivable, if I've done the service, so right, if Starbucks has delivered the coffee to UW, even though UW hasn't paid, under the accrual method, still revenue. You've done the service and all of your expenses need to be in that same period. So if I sold it in January, delivered the good in January, I want all the expenses that are in January. Again, doesn't matter whether they've been paid or not yet. All the employees that have worked, the depreciation that period, the inventory that's sold, all of that would get put in the same month so that I then have a good idea essentially what my income is, knowing my expenses are in the same period as my revenue. So I can see a better picture of, how much is my income in just that period. There's some other things, gains and losses that can come up. These are just from non-typical activities. So back to the table example, when we were buying tables for our pet store, well, sometimes we might end up selling those tables because we want to get new ones and you get some cash from it. That could show up if it was more than what it was on your balance sheet, you could have these gains or losses, but they're not related to everyday activities like our revenues and expenses. So in our income statement, we'll have revenues minus expenses. So expenses would just be all the costs of running that business for that specific period. And that gives us to our income, which is often known as profit too. So, or we also call this a P&L statement a lot of times, profit and loss statement. They're all talking about the same thing. So a lot of times in our P&L statement, we're going to see highlights from the categories. Now for your own companies, right, you can drill down into, let's say you create an income statement, you can drill down into these various categories to know what's changing. Starbucks, we don't, have the big picture perspective. We can see that their revenue and then where that's coming from, either company operated or licensed stores or other items. Then we have their product and distribution costs, which would mainly be their cost of goods sold. It's kind of our general category. So the cost of, actually buying the beans, all those inventory costs, these are just ones that have been sold. Then we have our operating expenses and then other operating expenses. So all, all the employees that you have, all the rent that you have, all of that gets in there. Depreciation and amortization expense. So that was back to when we put those items on our balance sheet as equipment or buildings, long-term assets. Over time, those then leave the asset category and they move into the expense category. Now it's back to the question, I can't remember who asked it, how many years do I do it over? Well, if, let's say you have it 7 years, then a little bit gets moved into the income statement every year for those 7 years. Then we have, just tons of expenses. We could spend like 10 hours talking about all the thousands of expenses that a company might have, but generally just categorizing them in different groups here. When we get to our total operating expenses, that just means everything related to your operations. And then we get all of our other kind of gains and losses or other items, which comes from this next one's just from anything that Starbucks has invested in. They sometimes, if they have to report others' incomes on their balance or on their income statement. Interest income, so from investments that they have, if they've got interest income, interest expense related to their debt that's due, and then you've got their earnings before taxes, income tax expense. Essentially at the end, the net earnings for Starbucks is $928. So that would be essentially their profit for that period. So they had more revenue than they had expenses for this period. before we start looking at some more ratios, I'm going to pause here, just check in any questions about the income statement in general, or components of it that I can answer for y'all.
They had negative interest.
They have so it gets, this is a good point. It gets kind of sometimes odd at the after operating income. These items are all subtracted, but once you get to this area, they have to tell you whether it's a plus or minus. So it's actually the 437 is interest expense that's subtracted as an expense. They just, since this groups both positive and negative items, they then have to show it as negative. But it's just like any other expense, it gets subtracted.
When they talk about EBITDA, would that be the operating income?
Yeah, so our earnings before interest, taxes, depreciation. Well, if there's a couple of them, right? EBIT or EBITDA, about different calculations on here. So if it's earnings before interest, taxes, depreciation, amortization, then you'll take this number and net out that depreciation and amortization. If we're just talking about interest, earnings before interest and taxes, then we're looking at that operating income. So sometimes look at it basically before depreciation and amortization. So you might have to add that back or after it, depending which one it's looking at.
So on that, hold on. So on this document here, you're saying the EBIT is the 11561.
Yeah, earnings before interest and taxes. Yes.
Okay, and then the EBITDA is what number on here?
It would take your income, so earnings before interest, taxes, depreciation, amortization. So then I would have to back out my depreciation. So I'd take that number and say, yeah, but I don't want to include depreciation and amortization. So I'd add that back.
Just so I have it in my notes here. So that's why I'm just trying to get it flat footed, right? So it's 1561 minus the 1431.
Correct.
Okay. All right.
Christine, I use QuickBooks, and there's two options I have: either run accrual or run cash. For cash flow analysis, which one should I use, cash or should I use accrual?
Good question. Yeah. So if you have the option to run either income statement, either under either method, for a cash flow perspective, the cash basis, the cash one, because that'll only include things that will be cash coming in as revenue and cash going out as expenses. Accrual, a bunch of, what's included in this revenue number, if you choose that one, will include things that you haven't gotten the cash for. So all of those things you've provided to your customers that you haven't gotten cash yet, that gets included in accrual, but it wouldn't be included in your cash.
Thank you.
Yeah.
Christina, this is Fernando again. Can you explain a little bit what goes into general administration expenses and then company operated store expenses? Where's your store operating expenses? We use a term called direct expenses. Is that the same thing? And are there other names that you can use for direct expenses?
Let me make sure I'm getting got the same terminology. So for the way, so there's a couple, so with our income statement, it puts them all into their categories by however we coded it, whenever we put those costs in. And then when I think about direct expenses, I almost take the expenses I have here and then think about them from more of a managerial, like internal perspective of, okay, which ones are actually related to that store or, specifically. So those would be my direct versus things like, the CEO salary, accounting staff, like that's going to be a common cost that's usually probably allocated across different stores potentially. And that's almost taken as a second, like, here's my income statement. Now let me rearrange this income statement and think about in terms of direct and indirect costs or direct and common costs to think about how do I know how much each store is actually generating? Because some of those costs that I have here, like general and administrative, are probably common across all the stores that Starbucks has, but right. I'd want to do a second analysis more on a store basis.
Okay, no, that makes sense. I'm just thinking about the audience because, for example, like we use direct and G&A, and then we have another category called fundraising. And I was just thinking if the audience, when they're looking at this, how would they fit into this model?
That's a good, yeah. So thinking about kind of there's many different ways to break this out, but in terms of comparing that to Starbucks, yeah, general and administrative would be things that are common across the company. Store operating expenses would be direct, that are specific to that company or specific to each store if you're looking at it from a store perspective. Great. Any other questions before we go? We'll check out some more ratios. Yeah, Dion.
In using EBITDA, and when we calculated that came out to when we calculated the EBITDA, it came out to $130.40, right? When we calculated EBITDA.
Yes, yeah, it should be it should be 339, close to 3,900.
Okay, so when the gentleman before me, he was saying operating income minus depreciation is what your EBITDA was coming out to?
It should be plus. It should be operating income plus.
Okay, so I wanted to make sure on, okay, perfect. I wanted to make sure on that. Then the second part to that was that, and I hope that clarified to the gentleman that answered that question.
That helped me. Yes, sir.
Not a problem. I got you. And then the other part to that is, how do we use that number EBITDA to better understand our income statement? Like, why EBITDA always comes up, IRR and EBITDA. How am I using that now to look at this statement?
Good question. Thanks for bringing that up. Of how do I look at these subtotals? How do I think through them? So why EBIT and EBITDA are used is so first I'll talk with EBIT. Why do I take interest and taxes and not include them? Well, they're not related to my operations. I'm going to have to pay taxes. My interest is not something related to my day-to-day operations. It's related to financing. So I want to take both of those out because they're not really related to operations. Depreciation and amortization expenses can also be taken out in that EBITDA because they have no cash, thinking from a cash flow perspective, there's no cash. You've already bought the equipment and the buildings up front. And you're just trying to match the expenses across, and it's, your best guess of kind of how to match those expenses. And it has no kind of cash impact. So that would be kind of my first thought is, why do I care about EBITDA? Well, it's really more aligned with my operations for that period. I'm going to have to buy a bunch of long-term assets and depreciate them. But let me take that out because that might not be necessarily specifically related to my revenues and then my, all the other cash flow almost implications of my rest of my expenses. I'm going to open up to the class too. How have y'all used, how have other people used EBITDA, and what do you think about when you are looking at that number compared to maybe your ending income?
Well, I can tell you when we used it in our company was basically to kind of see how profitable the company was. And when we sold the business, that was one of the pointers on what the industry was. So we look at the EBITDA for a certain period, and then depending on the industry, you usually have multipliers. So it can give you what good at selling point for your business was.
This is Fernando again. I think that whenever I think of EBITDA, I think about company valuation, just as Carlos has said. Like when I'm thinking about companies and I'm looking at MBEs, I look at what I think the value of that company is. So I look at it from a valuation perspective. That's how I look at it.
Great. Yeah, thanks everyone. I think, in terms of because we think about value of our long-term assets, we can already see it on the balance sheet. So we're just spreading those across on the income statement. So taking that out, you can already tell what the company has as an asset, and that can kind of be, again, more focused on that operations piece too. Great, good questions. Thanks everyone. Thanks for sharing too. I appreciate it. I think, this is great to learn from each other as we go through this process too. All right, our next one, and then we'll get more into ratios here in a little bit. But our last one is the cash flow statement. So this was a question brought up earlier about cash versus accrual if we are pulling the income statement. The cash flow statement can be really helpful if you're also using an accrual income statement. So this is where now it matches up with, okay, now I can see my profit for the period. So that was, for Starbucks, $9.28. All of my expenses, whether they were paid in cash or not, get matched with just that revenue for that period. But it's so important, as you all mentioned in the beginning, to know, do I have enough cash on hand? Like, what is my, cash actually balance? And comparing that also with the cash flow statement. So it shows cash inflows and outflows over a period of time. It can be separated into 3 categories then, and this is actually a really good place to compare cash flow from operations number. So that would be your inflows and outflows from customers, buying inventory, and comparing that with the accrual income statement. Because then I can see, yes, I might be making income on an accrual basis, but actually I am losing cash. And that's something to be aware of. Netflix is a good example for a large company. They're showing income, but they have a negative operating cash flow right now because they're spending lots of cash on developing new shows. So it's good to know, hey, if I don't have enough cash flow from operations, I'm going to have to get some cash flow from financing to support that in that investment in my operations. So using these in conjunction can be really helpful to say, sure, I might be having income, but I better know that I'm having some cash flow and vice versa. If I have cash flow, well, are those for the same period, or am I just collecting all my cash early, but actually I'm not showing a profit on an accrual basis? So the other 2 sections, investing is just when you buy and sell long-lived assets. So that's our long-term assets like equipment and buildings. The financing part, these are, going to be all 3 used together to say, how much cash am I getting from debt or paying off debt, and knowing where that cash flow looks like. For Starbucks, just to see, it's a very long statement. So I didn't put a screenshot up here, but this is the summary of their 2020 cash flow statement. We can see they have operating activities of pretty high, so they have quite a bit of cash. It's actually higher than their net income for the period, and that's just going to be timing difference between they got more cash than necessarily their income accrual method showing. So you will have differences between those 2. Then investing, so they spent quite a bit of money on investing in new buildings or equipment, and then they also had to get quite a bit of financing. It looks like additional debt was their biggest one in 2020. And what this also shows you is this ending change in cash is going to show you what changes on the balance sheet. So this cash flow combines things that it's a good way to look at comparing your income statement, but then also explaining what's happening to your cash balance over time. So just these are some short screenshots from their cash flow statement. So for their investing, their biggest thing was they bought more plant, property, and equipment. That's where their money's going. And then we can see from financing, they issued long-term debt and short-term debt. So that's their biggest increase. They did spend some money on buying back stock and giving back money to their investors through dividends, but that was offset by taking on quite a bit more debt. So that's where we see that positive balance at the end.
So Christina, does that mean that they took on debt to pay dividends?
They do have a positive operating activities number. So they could have taken on debt, in a short-term basis, but they do have quite a bit of cash coming in from operations. So since they did come out positive, I would say if that was a negative number for operating activities, then I'd be worried of, why are we taking on interest to just pay stockholders? All right, any
Can you go down that right column again?
Oh,
The
yeah.
financing activities.
Yeah, so this breaks down basically what's happening in this number here. Anything that's positive is saying where they are getting money from. So they got a lot of money from debt, meaning they took on a lot more debt.
Okay.
Where they spent most of their money was giving back to shareholders through repurchasing stock and cash dividends.
Okay.
And then Fernanda asked a good question, like, were we just taking on debt to pay dividends? And that might be the case in a situation where this operating activities was not a high number, but since it's a pretty high number, we'd say, oh, we're probably just distributing quite a bit of that back. But obviously, if we just look for the year, we are spending more money giving back to shareholders than the cash we actually brought in from operations. So we are spending some significant money on stockholders' distributions.
All right. Got it.
Great. All right. We are moving on to ratios now. Some more of them. And then after we look at some examples, we're going to move to the Excel document and have y'all work in teams again in probably about 15 minutes or so after the overview. So I know many of y'all also are not selling inventory, but some of y'all are. So if you are selling inventory at your company, this can be helpful to know turnovers that you can do based off of your financial statements. Now, you might already know this based off of your internal reporting on how fast you're selling inventory, but you can also find an estimate from your balance sheet and income statement. And again, this is an estimate of time, but it can be good to compare across companies in case you don't have all their details for other companies. We can take cost of goods sold over average inventory and then take that just divided by the number of days in the year. And that'll give us basically how quickly are we converting our inventory on our balance sheet to being sold on our income statement. This has to go under the accrual method, I should say, because under the cash method, you're going to see that inventory cost in your COGS income statement. So under the accrual method, if we compare Starbucks versus McDonald's, Starbucks has 73 days, again, on average, that it takes to go from being in inventory to being sold. And we just take that cost of goods sold number and divide it by average inventory. So that's just those 2 year beginning and end of year divided by 2. Now compare that to McDonald's, quite a bit faster. And you might think about these two companies very different in terms of what they're selling. Starbucks has a lot of things that last on the shelf for a long period of time. McDonald's, very quick, right? That should be, I would be worried if it was something like 72 days for them. So this can just be helpful to track over time too, to see what your turnover is and if it's going up or down and just comparing it to others too.
Can I ask another question? You may not know, this might be too much insight for their business, but if I'm thinking Starbucks, when they take possession of beans in the raw state, does that become inventory for them? So they got to take them, roast them, ship them, all that kind of stuff, right? So it's not just the stainless steel mug in the store. It's probably like their development process to get it to actual coffee that can be consumed is going to be a longer process.
You got it. Yep. Okay. Yeah. Raw materials all get added into the inventory costs. Exactly. Right. Yeah. Great point. All right. So that's what we're going to do, a couple of them. So hopefully this just kind of gives you a toolkit of different ones you can look at. Return on assets is another big one that we see. And this is a combination of basically how much return am I getting from my assets that I have, and that return being income. And this really is comprised of a couple of pieces that go into it in thinking about how effectively am I using all of the assets I purchased to generate that income. For Starbucks versus McDonald's, now it becomes, less on terms of the strategy. Some on the terms of strategy of the company can actually impact this, but in terms of less on the timing like inventory does. So for Starbucks, they had a 3.8% return, quite different from 2019. So I wanted to put that in there to compare, because as we can see for their income, quite a significant decrease in 2020, one from stores being closed and two from extra expenses from having them open and having more cleaning and all of that during 2020. They also had an increase in assets, whether that be from, some of that was from cash because they took on more debt, and some also from investing in new equipment and buildings like we saw in their cash flow statement. Now comparing that to McDonald's, this might be what, if you anticipated, before looking at these numbers, you might have actually been able to just guess that. McDonald's did pretty well throughout the pandemic in 2020 with a drive-through and just, ability to stay open through their drive-throughs a little bit more than maybe Starbucks. In 2019, though, they were much closer in terms of that return on assets. So I think over time, it can be important to look at these rather than just in isolation of 1 year. All right, we've got one last one before we start trying some out. The last one is gross profit percentage. And this can be really helpful to track over time and see how, this typically is pretty constant for companies of remaining a similar gross profit, because it's the difference between revenues minus cost of goods sold. So essentially looking at the margin between what you're selling and what you're getting from that. When we get into a percentage, we just take revenues minus COGS over revenue. So that's known as our gross profit percentage. All right, so I'll let you all look at this. We'll do it as a big group as far as what could have caused. So this was Starbucks from 2020, 19, and 18. Their revenues, COGS, gross profit, and gross profit percentage. We're looking for what caused Starbucks, or what could have caused the gross profit percentage to decrease from 70 to 67 from 18 and 19. So I'll give you a little bit of time to just think through this, and then you can ask the group or post via the chat your thoughts. All right, we had one response come in through the chat. Tom, that's a good point. Yeah, cost of beans coming in as far as increasing that cost of goods sold. And then it looks like it wasn't passed on to the consumer, where it's not that we, marked up, okay, we have a higher cost of goods sold, let's then keep our markup the same and, charge a higher amount to customers. They actually looks like they took a cut, as we can see in that margin being 17,982. Even though they sold more items, it ends up being that they had higher costs to selling more of those items. So that ended up that ratio being smaller there. Good point. Yeah.
And would 2020 be cost of goods sold would just be less because maybe the stores were closed or something for COVID?
It looks like it's
more profits.
Yeah, we have, again, lower profit. I mean, in a dollar amount, definitely that lower profit. Even in a gross profit percentage, it looks like pretty similar, almost between 19 and 20. So, we can't really see anything from revenues here because it's looking at the difference between, basically the difference between COGS and revenues. So we do have a decrease in revenue, but this number actually is pretty consistent with 2020 and 2019. But you're right, it could, a little bit of that decrease that it had could have been from, again, having more, the cost of shipping or something of those beans being higher, but not raising prices on the customer side. Yeah, transportation, all of the costs to create. So we see some of that through just our operating expenses, but for Starbucks, since they create a lot of their goods, they essentially have raw materials like inventory, or raw materials like coffee beans, and also some of the other costs to make that. So that can be some wages and overhead that goes into it that actually gets included in that COGS, and shipping too. There's one other thing that could be happening in 2019 besides the, well, there's probably a lot of things that could be happening, but there's one more that I can think of in terms of, one, their COGS could be getting higher. So their cost of materials or transportation's higher, and they're not passing that on to customers. There's something else that could potentially be happening in 2019 too. So I'm curious if anyone thought of anything different.
Could it just be the change in management?
And in what ways, Richard?
I'm not sure what the timing was, but didn't Howard Schultz step down?
So it could, I'm going to take it a little step further, and this could be different than what you're saying, or maybe similar, I'm not sure, but the direction of things that they're selling could have impacted this. So if you have a change of management that says, hey, we're not going to actually, maybe we're going to change our business structure and not sell things within, or outsource some of our things that we usually sell in a store, and we're not going to use that, sell that product anymore. The thought behind that, I'm trying to get at, is you could have changed your mix of what you're selling. And that can come from a management perspective. If I'm selling lower margin goods, like if I'm selling a lot of coffee, my investment is in stores and less on the product side in grocery stores, or vice versa, wherever my looks like. It could also be a mix of, I'm selling lower margin goods. I might be selling more of them from 24,000 to 26, but I'm selling more items at a smaller margin, which causes that gross profit to actually be a little bit smaller. I don't know if that is exactly where you're going, Richard, but I think management can definitely have an impact of, right, like strategy and what things you're selling that can impact this gross profit percentage too.
Yeah, sort of on that same path, but more thinking of just the decision making, you know, closing stores, you know, spending more on new stores.
Yeah, no, that's I mean, all of those decisions, right, can impact, you know, selling, what prices am I selling it at? When am I closing? When am I, you know, what products am I investing in? Those type of things.
Sure.
Yeah, good point.
Competition also, you see a lot of new shops popping up.
Yeah. Great. All right. So now we've looked at a couple different ones. Let me see what I think next. I've got a couple of overview slides, but then we're going to get into our Excel document and start doing some calculations and seeing some forecasting methods based off of Starbucks too. So budgets and forecasts, sometimes we use these terms interchangeably. Essentially what we're doing is trying to predict the future of the performance of the company on a financial basis. The way that kind of, at least from when I was at Holland America, how we divvied up these terms, where budgets were basically a plan, usually a 1-year horizon. So then we also had 5-year plans, 10-year plans that were much more loose, but our 1-year plan was pretty much like, all right, here's our budget. We do this whole budget cycle. We ask all the departments, we bring it together, and that's our budget for the year. But as things change, as we know for the cruise company, you know, passenger changes, ports change, things change based off our original budget. So our forecasts were then updates to that. So every single month we'd be asked to, okay, well, what's your updated forecast for the rest of the year? And that would allow us to change things based off of, you know, new things that happen in the economy and whatnot. So oftentimes, sometimes they get used interchangeably, but that's kind of the distinction, at least I make in my head, between budgets and forecasts. Now, a couple ways that we can forecast that we'll look at is one is, well, it's both an analysis and can be used as a forecast tool. And that's looking at vertical analysis that basically takes all the items of the income statement. So that means most of those are going to be expenses and puts them over revenue. It's almost assuming that everything is a variable cost dependent on revenue. Now, I know that's not going to be always the case, but this is kind of a first way to look at how is my revenue getting distributed across my expenses? You can make some interesting things within the income statement. And again, you can compare across time and also to companies of different sizes too. So this is looking down the income statement, then showing change in year over year. So horizontal analysis just looks at changes over time. So my revenue from last year to this year, what was my growth? And so that would show basically our current year minus base year, which will most likely be the prior year over base year to get a percentage change. So we're going to do both of these. We're going to switch to our Excel document for probably the next 20 or so minutes and start doing some calculations in there, and then having you try some out too. So what will happen is I'll do vertical and horizontal for 1 year, and then I'll let you all try that out and come up with your takeaways for the other years too, so you can kind of practice it out. Any questions though before I switch? I'm going to switch screens to my Excel file. All right, sounds good. All right, so if you have the Excel file open that was sent out, I recommend go ahead and pulling it. Oh, perfect. You were great. You read my mind. Thank you. You can download it there from the chat. And I'm going to be working through it here and doing some formulas so that we can see both horizontal and vertical. And then I'll have you try them out like I was saying for the other years. But just to walk you through what's in here, we're going to be focusing on these orange tabs. So ratio analysis. This is Starbucks balance sheet over 2018 to 2020. And then here's their income statement. So that's the tab we're going to focus on. We're going to get to these blue tabs in this afternoon session. So if you can go ahead and go to the vertical and horizontal analysis tabs, I'll give you a little bit of time to pull that up. And then I'll walk you through that for, we'll do 2019 together. All right, hopefully that gives enough time to get everyone to have it open. So I'm going to do 2018 over here in column K to do our vertical analysis. If just walking you through, you should already have it open, or it's already in there from your version, but just showing you what we're doing to kind of explain a little bit more. What we're doing is putting all of our expenses over our revenue number. So what is done here is basically like a hard-coded or absolute reference in column I, that revenue, because I want all of my expenses over revenue. So what this 29.1% is saying is, of the revenues that I brought in, 29.1% of revenues goes to cover my COGS. That's a decent sized number, but we can see that the biggest amount of costs for Starbucks, where their revenue is going, is actually going to be their operating expenses for stores. All of these I just did over total revenues. You could also maybe think about doing some of these just over the company stores if you wanted to look at it a different way. But for simplicity, I just did them all over total revenues. And every expense, so this just again does every single expense over the total revenue. If we get to the very end, we can see basically our ending earnings, how much of our revenue is actually going to our ending profit. And honestly, a pretty high amount in 2018 of around 18.3%. So that's our vertical one. I'm going to have y'all do both it for 2019 and 2020. Let's look at the horizontals, because I'll have you do that for the next year too, and then come up with your biggest takeaways. For the horizontal, you could use the same formula for the next one, but what's happening is I'm taking the current year of revenues of 21, I think it's billion, minus then the base year. So we use the prior year here over the base year to get the change. So basically what's that saying is there is a 9% increase from last year to this year in terms of our company stores. Pretty big decrease in our, negative 12% in our food services. And then what we see here is basically 7% change in overall revenue. So that happens for each of these categories. And we can see, right, our ending amount just takes the difference between those two income pieces too. But it lets us see a little bit more clearly, what are our big drivers, what's big changing over the years, and then also comparing to revenue for each of those expenses. All right, any questions on either of those interpretations or calculations before you start trying some out?
Can you do that calculation one more time? You're basically, it was just 2019, 2018 operate the company operating stores, the revenue from those, right? So divide that, and then you divided it by I-10 again.
Correct. Yeah, to put it over. So I want to say basically my change in the 2 years, what is that in comparison to my base year? How much did it increase from my base year? So yeah, over I-10.
Gotcha. Yep. All right, and that's how you got your 9%.
Exactly. Yep.
What's that? Now this is going to show you how bad I am in Excel. What's those two parens at the back of that formula?
Oh, got it. Okay, so I put an if error in front of it, which just means that if there is an error, then it results in a blank. So those two, what should I say, quotes are just to put a blank in, because some of these don't have, for example, don't have anything in them. And sometimes if it goes over 0%, it gives a NA and it looks pretty ugly. So if there is a error, basically it keeps it clean and it just gives you results in nothing because there's nothing there.
And then how do you get it to pull up like the numbers that actually are being in the formula, like that right there? What's that?
If you click on the cell and then click on the toolbar here, up here, it'll highlight your cells.
Okay, there you go. All right.
Great, awesome. Any other questions? You should be actually, let me allow screen sharing. So whenever you get into your breakout rooms, we're going to stick with the same ones for the rest of class this morning, but the afternoon we'll get you in your groups based off of your level of comfort. So we'll get it all sorted out for the next one. But in this one, let's go ahead. What you're looking to do are these 3 questions. I think for time's sake, let's skip step 3 and just do step 1 and 2. We've already actually calculated all of the ratios. I was just going to have you try it out, but ignore that. I'd rather focus just on the first 2 parts. So you're looking to do 2020, 2019, and then the horizontal analysis for 2019 versus 2020. Once you've done that, which you can copy a lot of the formulas over, the biggest part is then analyzing it. So what are your biggest takeaways? If you were running Starbucks, what would you think about as you're forecasting for 2020, or sorry, 2021? What are you thinking about and how things went over the past couple of years? Okay, in your breakout rooms, you can share your screen. So if someone is like, hey, I'm really savvy at Excel, I'll just kind of show you what I'm doing and everyone can kind of follow along. You can just click the share.
We couldn't share in the last breakout.
Yeah, thanks, Tom. I realized I didn't click the button. I just clicked the button, so you should this time. Thank you. So yes, you should be able to share your screen in the next one so y'all can follow along the same one. Sorry about that first one. All right, I'll be here. You can, if you've got any questions, otherwise rooms are open. We'll come back in about 10 minutes. Hopefully that's enough time to go through those takeaways. All right, everyone, welcome back. Hope you had some good discussions in your group. I went ahead and just put the 2020, 2019, and then horizontal analysis over here. Just a heads up, I think there was still a formula left in there, but it was subtracting 2 percentages. So this should be the correct ones over here of the difference between the 2 years and dollar amounts. You could do percentages, but it makes much more sense probably in the dollar amount perspective. I will send out this after the session's over. So, you can go through the formulas, you can look through it. What were some big takeaways though? So if we look at, across horizontal analysis or the vertical analysis, what are things that you would want to look into more or think about?
So for our group, we had questions about the restructuring charges. We were wondering, because it was such a huge jump from 2018, 2019 to 2019, 2020, we were wondering what those charges kind of entail and what could possibly mean by that.
Yeah, that's a good point. If you have something that completely drops off, what are the reasons for it? What happened? This came from, I can't remember exactly where the restructuring, we could look in their financial statements and they would give some description. Oftentimes it's from purchasing another company. So if, Amazon would have this when they purchase Whole Foods, it's a one-time cost. So it wouldn't be something that would most likely be recurring consistently, but is something that they highlight as a kind of a one-time cost, things that are abnormal to keep them separate from operating expenses because they, again, don't expect that to continue on. So it's good to have it noted and just make sure that, hey, am I expecting this going forward when I'm forecasting, or should I keep this pretty much zero going forward?
So what we came up with is basically between 2019 and 2020, COVID happened, so our sales drop off. They probably kind of had a couple of months where they were totally shut down, but they maintained their personnel. They didn't want to, you incur into new training and anything like that. They had to kind of invest into the stores to sanitize them, to make people feel comfortable to going back into the stores. So the cost of goods sold kind of maintained the same, which that's obvious, but you had an increase in basically every single other expense in operating expense. And that's why you have a big drop on your operating income.
Yeah, it's a great point. I mean, pretty big, significant, especially store operating expenses went down and then went, pretty significantly back up. What else? What other takeaways did y'all come with?
what was the, we were looking at the income from equity investees. Would that be like issuing of stock or something?
This
Is
one,
that a-
so yeah, that's a good question. Where this comes from? It's coming from. So what happens is if Starbucks owns basically greater than, oh gosh, what's the percentage? I'm trying to remember. Somewhere between 20 and 25, basically between 20 and 50% of another company is like the general guidelines. They actually have to include some of that, the income of that investee. So let's say Starbucks owns 50, let's go with actually 40% of another company. They include some of that income from the other company on their income statement. So this is actually has nothing to do with Starbucks. It has to do with their investment.
Okay.
So it looks to be pretty consistent over time. Dion, yeah.
So when I'm looking at this restructuring charges, I'm assuming that restructuring is during the COVID, during the time that they were down, what they used some of their income or some of their revenue to do is do restructuring, improve their facilities. Is that?
It could most likely probably that restructuring would be an internal restructuring a lot of times, like rather than, investing in new buildings or whatnot. That could be something that they definitely have taken on. But that specifically restructuring has a lot of times of when they're buying other companies or redoing, which could have happened during COVID, right? Rethinking how I want to operate as a business going forward. If I'm cutting, maybe I'm putting all accounting in one department and I used to have them in all different parts. I just think about this when I was at Holland. We used to have accounting in LA and Seattle, and then we merged them and said, hey, we only need one location. And so that would be kind of a restructuring of reorganization, rethinking about how the organizational structure is too.
So I guess maybe an idea of saying, hey, since we don't have people that are in store, we're going to put more emphasis on our ability to deliver or our ability to service through the window versus having people inside our facilities or PIP, for protection, personal protection, PID or whatever whatever it is, that type of stuff.
That definitely will come through. Where mostly that's going to come through, though, is probably that store operating expenses. Restructuring, probably not as much. Some could for sure, like the strategy and internally structuring how the company's set. Actually, we can probably find out from their 10K exactly what's in it. But that would be my initial guess. And I think what you're talking about, right, is additional costs of running, right, the business, and that's going to probably come in. But you're right, definitely would affect it. And that's probably where a lot of that's coming in, is this operating expenses too.
Okay, just wondering what would cause such a drastic increase.
Well, it almost, though, if we look over the years, it almost is the anomaly here a little bit is 2019, because they had some restructuring charges. Again, these would be a one-time thing. So I know they had Tivana that they, set off as a different, they were buying and then they sold it off. So all of that, those kind of one-off fee costs can come through this, which totally could have to do with some COVID impacts. But I also think we'll see COVID impacts elsewhere in the income statement too.
Okay.
Question, Christina, if you see a reduction in force, would that also be caught in the restructuring charges? The cost for the reduction in force?
It's a very, it depends. I think, let me see what's in Starbucks 10K and I'll come back with y'all in the second half, because it can be so many different items that get in there, but it's essentially think of it more as a one-time fee, not a typical thing that we would consistently see. So that could include some of the COVID items, restructuring of like employees, those type of things. Yeah, let me do a little bit of digging though. I'll come back. I'll have a better idea for Starbucks. They should probably describe a little bit since it's a one-off item.
Thank you.
Great. Thanks, everyone. Thanks for your insights. A lot of changes and some of them consistent, which is, I think Carlos had mentioned this earlier, is that, right, our gross profit or cost of sales stayed relatively constant, at least from 19 to 20. We did see a little bit uptick from 2018, but nothing super drastic from COVID impacts in 2020. Now, how we can also use this information, we can see then, the changes over here and percentage, it's good to look at, but also we might want to look on a dollar basis too and say, hey, is this unit, maybe it changed by 20%, but maybe the dollar amount's not a huge impact to be worried about. So that's what we can kind of see in these changes here. Another way to think about using this too is this is a very high level forecast, not specific to, because we have such big groups for our income statement. But let's say we are forecasting further out. We don't have exact numbers, but we say that our revenue wants to grow by, let's say, 7% this following year from last year. So if I take my prior year 2020, so maybe I say I think it'll grow 9% from 2020, or sorry, I think I said 7. So if I just times that times 1.07, that'll basically increase it by 7% from last year. So if I have a new, basically whatever I wanted to put there, it doesn't have to even be a percentage of last year. I could just say my sales forecast is, $30 billion. From there, again, these are just very high level numbers, but sometimes a good way to just estimate, especially further out. Generally, my cost of sales has stayed the same closely, at least over the years. So maybe I take an average, or maybe I just take last year's and I say, well, my cost of sales would be 100% dependent on what my revenue is going to be. So I can take that new revenue number and multiply it by this percentage and basically forecast, again, very rough numbers, but forecast what my cost of sales might be with that new revenue. Now, some of these might stay consistent, be fixed costs so that they might not change, but some might be dependent on revenues and have more of a variable. Let's just assume that most are dependent on the more sales I have, the more costs I might have. So for operating expenses, maybe I would say, yeah, I think those are, mostly dependent on sales. And I think I'm going to have a lot of high operating costs because 2021, I still have stores closed, or maybe you adjust that percentage a little bit. Same thing here. So for the next one, maybe I say, yeah, I think that'll, also be dependent. What I can do is add a dollar sign in front of, if I want to basically absolute reference this one number and say, yeah, I think actually most of these, so maybe we go with, hey, most of these are dependent on revenue. And we basically can drag that formula down and say, hey, assuming everything's dependent on sales and I'm going to have similar percentages going forward. If I drag that formula down, sorry, one more. I can basically get an estimate. Again, this is so very high level as far as like, there's so much more to it that we'd want to probably think about in our forecast. But from a top level perspective, I get an estimate of maybe what my future income would be, assuming all the same percentages. Now, maybe some of these items we'd go through and say, yeah, well, depreciation is not dependent on sales at all. So maybe I keep that more consistent and not increase next year. And maybe I make some adjustments to these other areas. But at least what this does is gives me kind of a baseline of, hey, if I do increase revenues, assuming all the other cost percentages stay the same, what type of profit am I looking at here? So just a way to kind of forecast, especially, you're looking 4 or 5 years down the road, a good way to kind of project future growth and income too. All right, any questions on any of this before we look at, I know we've got about 15 minutes left, so we'll do a couple more slides before we finish up this morning. But any questions on the Excel document before we switch over?
Can I get your formula for the expense from C4 to C15?
Yes, so all of these are taking revenue, and I actually ended up absolute referencing that revenue number times, then I just use 2020. Now maybe you'll use 2019 because 2020 was such a weird year, and then just multiplied it by whatever that percentage of sales were in the previous period. So same would be, again, assuming that these are all dependent on sales, revenue, and then times my operating expenses, which are around 45% of revenue goes to those expenses.
So once you estimate the total revenue, then everything else just kind of falls down.
Yeah, assuming that, again, there's a lot of assumptions made where there would this is definitely very big picture, assuming that everything is based off of revenues, where some of these costs are fixed, and my depreciation, whether I sell more items, assuming my, no more buildings are added, that depreciation should stay relatively the same.
Yeah.
But it might also, go up a little bit if you have more buildings. So this is taking a big assumption that everything's based off sale, but at least gives you a benchmark and somewhere to start with.
So you want a sandbag for your and for the Wall Street, you tell them that you think you're gonna get 23 million or billion, and then you get 25, and then everybody's happy, right? So you gotta, if you're publicly traded, which I'm not, right? So different calculations if you're publicly traded.
Yeah,
So
yeah. There's a lot of added pressure on hitting those estimates.
Exactly.
Great, thanks everyone. Good questions and analysis. We got a couple more to go through. Thanks for sticking with me. I know this was a lot to go through, so I think just take pieces that you have, and I will definitely share these after the session too. So all the formulas and stuff will be there afterwards. There's just one more, a couple pieces to think about. This was very high level, forecasting out, making these big assumptions. You could also, a lot with forecasting, you can also do kind of from a very micro level perspective too. So that's what I'm going to share with now to kind of wrap up that forecasting piece too. So there's lots of different ways to think about forecasting, but another way is also to focus on from like a cost equation perspective, which might not make sense for all companies. It made a lot of sense with the department I was used to work in because ours were so based off of set numbers and then based off of passengers for a cruise industry. So again, take or leave kind of what works best for your company, but I will show you a cost equation perspective too to think about when you are doing budgets. First off, so thinking about, it's really important, at least for the cost equation, well, for any of it, is think about your fixed and variable costs. So just a quick refresher on the difference between those. Fixed costs, variable costs basically changes as activity changes. So this would be the more things that I'm selling, for example, the more volume I have, the higher my cost of goods sold number would be, because more things I sold, more cost of that inventory. Versus if things are relatively fixed, so that might be rent or lease expense, or depreciation could be one too. If I sell more items, well, I still have to, I still pay the same rent. Or what happened during COVID, right, for Starbucks, if I still have my store open or even not open, I still have to pay my rent, even though I'm not having any revenue. So it's staying relatively consistent. On a per unit basis, now variable costs, every additional, let's say Starbucks coffee they sell has a similar variable cost attached to it. Versus a fixed cost, it doesn't change, but the more coffee that Starbucks is selling, well, that's going to essentially make my rent expense feel like a smaller impact, because now I'm having more revenue to cover that fixed cost. But it doesn't actually decrease per unit, but it becomes a less of an impact the more things that you're selling. And then one more item is just a mixed cost. So it combines a fixed and variable component. For example, renting a U-Haul truck, you would take, $20 is like the base price, plus they charge you then per mile. So this is kind of a mix of both variable costs and fixed costs in one. And this can happen quite a bit for different types of impacts too, or different types of costs. So during COVID, this was Starbucks was an example, but also airlines, they were trying to move to more variable costs rather than fixed. And the huge reason for that is, hey, if I'm not having, revenues coming in, well, then I don't have to pay those variable costs, versus fixed continue no matter what, whether you have revenue coming in or not. So trying to be a little bit nimble in those time periods of switching, if I can, to some variable costs to not have to pay those if I don't have revenues coming in. So let's just do a quick review of variable and fixed, and this will give us just enough time to kind of go through the last cost equation, kind of forecasting to combine it. But go ahead, just try this on your own. I'll give you a couple minutes to think if it's most likely variable or fixed. Let's do probably dependent mostly as our activity base let's imagine it's mostly probably going to be sales or production. So ask yourself, does this cost change if I sell or produce more items? Most of these I think are focused mainly on the sales side. Okay, I'll let you look over this. We'll do a couple polls. We'll come back in about 2 minutes. All right, I'm gonna put some polls up and ask variable or fixed for these just so we can get perspectives of the whole class. Let me, okay, there's gonna be a lot of these because there's a lot of different ones. We'll do this for the first couple ones and then maybe just go through the rest of them. But what did y'all get for the first one? So hamburger buns in a Wendy's restaurant, variable or fixed? All right, thanks everyone. We've got about 80% saying variable. I would, oops, sorry, got a little bit excited there. Yeah, I would agree, the more buns that the more things I'm selling, as far as, more hamburgers, essentially the more buns the total cost is gonna go up. Every single bun that you buy is probably similar in price, depending on a lot of other things happening in the economy, but relatively similar. So the cost per unit is relatively same, but in things of Wendy's as a whole, costs will go up for this cost of goods sold or, essentially the bun expense because the more things are sold. So generally that variable cost. All right, let's do the next one. What y'all get for advertising? All right, we're much more 50-50 on this one, almost exactly. So let's hear from both sides on this. What did y'all think for advertising, fixed or variable? And maybe I think there's arguments for both sides. So I'm curious what y'all were thinking.
I think on the so you can have fixed marketing cost, and I think you can have fixed advertisement cost, like how much it costs per ad. But it's a variable cost for me because it depends on what you want. Like are you running a campaign? Are you doing a billboard? Are you doing print or grassroots? Like, what type of advertisement? There's a lot of different, your advertisement can be a variable or a fixed cost depending on what you're asking for.
So that's it. Yeah. So, in each one of those though, it's a fixed cost within that, but you have different groupings, right? So you're right, like the cost could change. Not based off number of things that you're selling, but you're right, different buckets that you choose and different types. As we think about forecasting, it might not be the same amount you're spending every year. Maybe it goes up because you have a bigger campaign, not necessarily because you're selling more items, but just because you've changed the type of product that you're buying. Yeah. Richard, yeah.
I would think you would still have a budget for the year on what you're going to spend on the advertising.
Yeah, that would be, generally, right, maybe you have X amount each year and you spend it different ways. Yeah.
I agree, Richard. That's a good point.
Yeah, so as we're forecasting, we're trying to forecast how much I'm spending, unless you have a big campaign you're deciding to do. And that would just be almost it's called a step fix, where you go from one fixed cost and you kind of move into the next, big jump. It doesn't mean that it's changing based off sales or production. It's just the amount of money you're spending on it. And the only thing that I can't, something that would be though a little bit more variable in some instances is if you're doing click-based ads. And if you don't set a, ending target for like, hey, I only want to spend $100. If you just say, hey, I'll spend, unlimited amount of money if these people are clicking on it, then you could see some variable components there. But I think to Richard's point in the end, my budget probably is going to be set as how much I can spend on marketing and advertising. All right, shipping costs. Let's do, we'll do one more poll and then we'll just go through. Oh, wow, we are 5 minutes less. Okay, we're gonna go rapid fire through the rest of these. I just realized it. So shipping costs to refrigerators for Lowe's. I think this one has been brought up as between variable and fixed, between what type of shipping contract you have. So variable, if it's literally every single refrigerator you have to charge a price for it as shipping, then it would be variable. But if it's just based off of a truckload and how many you can fit in there, then it might be more fixed. So definitely can, I think this one it depends from different perspectives people have brought up. Insurance is going to be most likely fixed, staying the same whether you sell more or produce more items. In general, rent going to be more fixed. If I have more customers come in, I still have to pay that same rent. Salary relatively fixed again. If I sell more items, not going to change the total amount I'm paying to that employee. Commissions, though, will be based off of things that are selling. So the more things I'm selling, the higher that cost is going to be. Depreciation, relatively fixed. Again, it could go up based off if I'm buying new buildings, but again, not based off of sales or production. And then steering wheels, those are going to be mainly variable because every additional car that I produce or sell, I have the cost of that steering wheel in it. All right, any questions on any of those ones as a variable and fixed? We'll come back to this definitely in the second half, applying these a little bit more. All right, the last thing then, I know I have 3 minutes left before our 2-hour break, and then we will come back and we'll dive much more into some of the questions y'all asked about cash budgeting and also about looking at kind of fixed costs and direct costs and segment reporting too. The last part to end today, though, is just thinking about, okay, just an example of how fixed and variable costs were used in budgeting, at least from my perspective when I was at Holland. We did, my group was in charge of port forecasting. So there's thousands of ports that the company stops at, and we have to forecast that for the next year, which is for all the ships in every port. Variable costs would be things like passengers and time. Fixed costs were things that I don't care how many people or how long I'm there, I have to have security and I have to have pilots bring the boats in, and for example, in Seattle. Mixed costs would be something like a set fee plus a usage fee. So shore power in Seattle, they have to pay to basically set it up, and then they pay for the energy that's used. So I know we took a big picture for Starbucks. We used to do this from a very small level and use budgets to also assess controls in place and assess our budget to actuals. So these are not real numbers. I just made them up, but this is generally the format that we followed for each port. Is we sum up each port and then sum it into total. So passenger fees, bag fees, water, they were all based off number of passengers. So I would need the sales forecast. How many people do we expect on this cruise ship? And that'll flow through to my cost for all my passenger variable costs. Then we would add all of our time variable costs. So the longer that I'm in there, the dockage fee and the moorage fee would go up based off time and port. Usage, so shore power, there's a set fee and then there's a power usage. So that was a variable cost, so a mix of those two. Lastly, we had some fixed things. They wouldn't change based off how many things how long we were there, our passengers. And this would basically get us the budgeted cost per port call, which depend on day of the week, season, all of that. So we would do that for every single port and basically then summarize that all into our port budget, which is just probably one line item on the entire income statement. But I wanted to show you just from a ground up perspective, another way to approach forecasting and budget. So from a high level perspective with Starbucks, and then more from a ground up perspective to be a little bit more exact. All right, everyone, I know we're right at 11 a.m., at least Seattle time. For many of you, this is later in your day. We're gonna go ahead, so I'm gonna skip this. I'll put this as an example though that y'all can look at later of just applying it. But a couple of takeaways from today, everything that we looked at this morning. What will happen now is we'll take a break and I'll hand it over to either Will or Fernando, just any other logistics, but we'll take a break. We'll come back at 1 p.m. Seattle time. So, and then we'll be 1 to 4 and finish up the second half of this.
Thank you, Christina. This is Fernando once again. So I appreciate all the work that everybody's been putting into this. This has been a great first session. Christina, thank you so much for leading us through this. I hope that everybody on the call has benefited from this. So we'll be back at 1 o'clock our time, which is, and we tried to make the adjustments so that we could take care of the people on the East Coast as well as the West Coast. but we were a little bit selfish also taking care of the West Coast because we always run into the East Coast taking care of themselves also, right? So we're trying to balance everything else. But Christina, great. Thank you so much for the time. Will, anything from a connecting back in at 1 o'clock or 4 o'clock, whatever your time zone is?
No, the only thing to take note is it's going to be the exact same link that you used for this morning's session. So you just want to re-click that link for the afternoon session in a couple hours.
Perfect. And again, we designed this so that all of you could have time to go and run your business while at the same time have a great learning experience. So thank you so much. We'll see you guys back in a couple of hours. Thank you, Christina.
Yeah.
Christina, come back.
Yeah, come back.
Yeah, come back. Yeah, come back. I hope everyone comes back. I'll be back.